Namaste, welcome to Arthaniti. Today being Wednesday, I will talk about a type of mutual fund. And the fund that I'm going to focus on today is ultra short term fund. Yes, it is a debt fund. Why is it necessary? Why? Because of the rising interest rates all over. This fund is a must have in our investment portfolios. Now, what happens is with inflation rising all over the globe, not only in India, the central banks of countries, like we have the Reserve Bank of India in our country, they rise interest rates, they hike interest rates. Reserve Bank of India also hiked the repo rate by 50 basis points, and today it stands at 5.90, where it was 4% in April. It has risen 1.90% in the last 6 months. Now, why is Reserve Bank of India rising these rates? Well, basically the aim is to tame inflation. The aim is to bring down, lower the prices of goods and services. How that is achieved? By increasing the interest rates. The Reserve Bank looks at sucking in extra liquidity available in the market. Now, when money available in the market is reduced, people will get less of that money, and correspondingly the demand for goods and services which they intend to buy with that money also gets affected. With this, what happens is, since the demand has lowered, the prices of goods and services also come down, effectively taming inflation. Now, this is what a monetary policy this is how a monetary policy works. Now, in such scenarios, what happens is, since money from the central bank becomes dearer, people like the banks and intermediaries look for other ways to raise liquidity, look for other ways from which they can raise money. Now, government bonds, GSEC, or fixed income securities are a source from which they can fulfill their liquidity requirements. In this case, in such scenario that we are facing currently, where the interest rates are rising, it is going to have a positive impact on the bond market. See, what happens is, we invest our money keeping in mind a certain investment strategy, but that investment strategy and the investments that we have done cannot be kept airtight. Why? Because the situation around us is constantly evolving, is constantly changing, so we have to make necessary changes in our portfolio so as to adjust to that situations that arise around us. Correct? Why is this necessary? We need to tweak our portfolios a little bit so that we take advantage of the situations, and the decisions to make changes to the portfolio only help to increase our net worth, only help to increase our wealth. Correct? So these little changes are necessary to be done. During COVID, okay, when we faced lockdown, some of us lost our jobs, some of us lost our sources of income. Sources of income got badly affected. Most experts suggested that an emergency fund was the need of the hour. If you did not have an emergency fund, it is very, very necessary that you keep a fund of at least 6 months of your expenses safe, liquid, aside, not to be touched. Correct? That was what was told by most of the experts. Now, this fund basically to finance your regular expenses, monthly expenses for a period of 6 months. Why? Because till that time you could find a different source of income. Correct? So, that emergency fund was suggested to be kept liquid at your disposal. Whenever need arises, it could be used. Correct? Now, most of us either keep this money in our savings account or we invest it in short term fixed deposits. The kind of interest rates that the banks are offering on the savings accounts one should also know before we dig into details about the ultra short term bond funds. Now I will show you an infographic which will help you understand, which will give you a fair picture about the kind of interest rates that are prevalent in the market. Various banks and the interest rates that they are offering on the savings account is what this infograph will show you. If you see this picture, if you see this infograph, this I have taken from a website bankbazaar.com. Now, if you see this table, it will give you a rough idea about the kind of interest rates that are prevalent in various banks. Now, a bank like HDFC is offering savings interest from 3 to 3.50%. Kotak Mahindra Bank from 3.50 to 4%. SBI, which does not feature in this list, which is the largest public sector bank, government bank in India, is offering a mere 2.7% interest on savings account. Now, I hope you know how savings account interest rates are calculated. They are calculated on your daily closing balances and are credited to your account every quarter. So, whatever amounts you have in your savings account at the end of the day, interest will be calculated on a daily basis and credited to your account once every quarter, with rates like 2.70 to 4% that bank like Kotak Mahindra Bank is offering you. If you can earn higher than these rates, if you can earn a return which is higher than these rates, then you should definitely think of that option as well. Let me show you an infographic which will give you a fair idea about how FD rates are currently in the market. Right, now this table will give you a fair idea about fixed deposits which are lower than 1 crore, normally retail fixed deposits, and the rates that different banks are offering. Now, a bank like ICICI Bank is offering 3.75 to 4.65% for a FD between 6 months to 1 year. Correct? We are talking about a period of 6 to 9 months wherein you need to have your emergency fund. A bank like HDFC, on the other hand, is offering rates in the same bracket, 3.75 to 4.65. But all these rates are for a period 6 months to 1 year. See, when FD rates, savings rates are so less that there is hardly any return that you will get out of it, and the focus is not on earning or beating inflation. Inflation is way higher than the rates that are offered in your savings account or short-term fixed deposits. Inflation The latest inflation figures show inflation in India at 7.1%. So, which is almost double than what your savings and short-term FDs are going to give you. But the focus right now is not earning money, which earning returns which are higher than inflation. The focus is safety of your corpus and liquidity. Liquidity is how soon will you get that money if need arises. So the focus is on liquidity and safety of your capital. Correct? But in case there is an option where you can earn rather an interest which is higher than what short-term FDs and savings accounts are offering you, you should definitely give it a thought. And ultra short-term bond funds is one such investment wherein you will get returns which are higher than your normal savings account. Now, what are ultra short term funds or ultra short duration funds? Well, basically, these are debt funds. They invest in debt and money market securities which have a short duration, which the time span for investments in these funds is between 6 months to 1 year. Now, many people might get confused between a liquid fund and ultra short term fund. Well, there is a subtle difference. The difference between a liquid fund and an ultra short term fund is the duration of its underlying investments. While in a liquid fund, the underlying investments cannot have a maturity of more than 3 months, 91 days. The duration of investments underlying the ultra short term fund is somewhere between 6 to 9 months, not more than a year. Understood? There is a subtle difference. The maturity of investments in a liquid fund cannot be more than 3 months, while for a ultra short term bond fund it can be between 3 months to 9 months. That is what is the difference. So the investments in which ultra short term bond fund invests has a higher, longer maturity than a liquid fund. Basically, if you are looking for an investment of less than a year but more than 3 months, this is the fund you should look out as an option to invest your money. Now, people who are conservative, who are risk averse, who have a low risk appetite, this fund is more suitable for such people. But if you still want to earn higher than a savings account interest, this is the fund that will suit your requirements. Before you decide to invest in an ultra short term fund, there are certain factors that you should keep in mind. Firstly, the tenure of your investment. What period of time do you have in mind to invest your money? If it is for your emergency fund, then the period is surely less than a year. And for such kind of fund wherein the need can arise any time, the money has to be liquid and the money has to be safe. So, these two criterias should be your decision making points. So if you have a time span, a time horizon of less than 1 year, you can definitely think of ultra short term bond funds. If you have a time horizon which is more than a year, there are other debt schemes which can fulfill your requirements. One more factor that you should take into consideration is expense ratio. Now, since the duration that you have in mind is less than a year, so it is a short time span that you have in mind. These funds which are targeted for that time span obviously are not going to give you returns as an equity fund would. They would give you lower returns. Since the returns are lower, always look out for the expense ratio, the fund management expenses that a fund house charges to the fund. A lower expense ratio will give you better returns. So always look out for funds with lower expense ratios. There are different kinds of risk attached to a debt fund. These funds are not completely risk free. Nothing is risk free nowadays, correct? Except for say your PPF and government backed sovereign investments. But again, they don't give you the kind of returns, the liquidity that is expected if in a short period of time, correct? So there are different kinds of risks that you should be aware of. One is the interest rate risk. What if today RBI is deciding on rising the interest rates to keep inflation in check? Say 2 months down the line, suppose the RBI reverses its stance, it starts reducing the interest rates. Won't it have a negative impact on your investment? Yes, it will. But again, you should be aware of your surroundings. Global bodies like the IMF, World Bank, everybody is forecasting that the inflationary trends are not short lived. They are going to go on next year as well. Few economies are at a risk of entering recession too. So, this phenomena that we are facing of rising prices everywhere is not going to be a short term phenomena, since it is going to stretch beyond short term. The RBI stance of hiking interest rates to tame inflation will not be reversed, does not look like it will be reversed, or interest rates will start cooling off, will start going down. So, this rate hikes are here to stay. So, interest rate risk, when you are having a time horizon of 6 months to 9 months, 3 months to 9 months, does not look as if there is going to be a significant reversal in what is happening, what is currently happening. So, interest rate risks are comparatively low in today's situation. Credit risk. Now, see, credit risk is the risk which relates to the credit worthiness of the underlying securities. Where is your fund investing the money that you have put into the fund? What is the credit quality of the investments where the fund is investing? Please see to it that the portfolio of the mutual fund that you have selected has high rated securities. If they are government backed GSEC securities, they have sovereign guarantee, right? But for private securities where the fund has invested money, see to it that they have good credit ratings, AAA, A plus ratings from various credit rating agencies like CRISIL, ICRA, etc. So always look out for the quality of credit worthiness of the underlying securities of these mutual funds. And lastly, there is liquidity risk. It relates to the fund house. Do you remember what happened with Franklin Templeton debt schemes? There were 6 of those schemes which had to be closed down because there was a mismatch of the maturity of the underlying instruments and redemptions from the fund. So the fund was low on liquidity. It could not match the redemptions and the underlying maturity of the investments, and the fund had to be closed. People uh, got all their money back, and the issue was resolved, but such problems are headaches. So look out for the performance of the fund house, look out for the credit worthiness of the fund house, look out for the fund manager who is managing the fund. These things are necessary because it is your hard earned money. You have to take in some efforts, correct? So look out for interest rate risk which are lower given the current scenario. Look out for credit risk and the kind of credit ratings that the fund is investing in, the credit ratings of the investments that the fund is investing in, and liquidity risk of the fund house. These are the kind of risks that you should be aware of, and you should know about these risks before investing your money. Regarding taxation of ultra short term bond funds, well, if you keep, these are debt funds basically. So if you hold them for a period of less than 3 years, which will be the case if you invest in an ultra short term bond fund, you will attract a short term capital gains tax for any gains that you make on your investment. Now, being a debt fund, this will be taxed at 30% plus the surcharge and the cess applicable. If you hold it for a period of more than 3 years, which is highly unlikely for this kind of an investment, long-term capital gains tax will be charged, which is 20% with indexation and 10% without indexation benefit. For any dividends that you earn from such funds, dividend is not taxable in the hands of the investor. So the mutual fund house will deduct dividend distribution tax DDT at the rate of 25% plus surcharge plus cess, and then credit the dividend to your accounts. So this is what is regarding taxation of these funds. This table gives you in detail the first 5 best performing ultra short term bond funds. The first position goes to Nippon India, which was the erstwhile Reliance Mutual Fund, which has given a 1 year return of 4.85%. Correct, and it has a moderate rating, a moderate riskometer. Uh, which has a fairly good expense ratio of 0.34% and which is more than a decade old, correct, followed by Bank of India, ICICI. These are all big names in mutual fund houses, so these should be a few funds that you can look at if you are planning to invest in ultra short term funds. Once again, this is not a recommendation. I'm just giving you the facts and I'm telling you the details about this kind of mutual fund. If you have the risk taking capacity, if you have a time horizon which is less than a year, more than 6 months, more than 3 months, I'm sorry, where you want to invest your money and you're looking into cash in returns higher than your savings account, then this is an option that you can think of. Please assess your capabilities, your risk taking capacities, and then decide on investing money in ultra short term funds. This is just an educational video. Thank you.